Here's a myth: live in Portugal and you'll be taxed twice on the same income. And its opposite twin: move here and foreign income becomes tax-free. Both are wrong. What actually protects you is quieter, double-taxation treaties and Portugal's foreign tax credit. Today, how foreign income is really relieved here by the rules, not the marketing. Start with the core rule. If you're a Portuguese tax resident with foreign income, Portugal grants a credit for international double taxation. You deduct the lower of two amounts: the tax you actually paid abroad, or the portion of your Portuguese income tax that corresponds to that same foreign income. The lower of the two. That's Article 80, one of the Personal Income Tax Code. Now add a treaty. When a double taxation convention applies, there's a ceiling. The credit can't exceed the tax paid abroad under the terms of that convention. So if the treaty says the other country may tax only up to a certain limit, that treaty limit, not whatever was withheld beyond it, is what Portugal will credit. Why does a treaty matter so much? Because Portugal has an extensive network of them, conventions with dozens of countries across Europe, the Americas, Asia, and beyond. Each one decides how two countries share the right to tax the same income. If your country has a convention with Portugal, its specific text is what governs your situation. Always check whether one exists. Here's what treaties actually do. They allocate the right to tax, income type by income type, employment, pensions, dividends, interest, property. Most follow the OECD model as a template, but the real answer always depends on the specific convention. One common example: private pensions and public sector pensions are often treated differently. So never assume read the treaty that applies to you. Treaties also cut withholding tax at the source. In Portugal, Form 21 RFI is used to claim exemption or reduction of Portuguese withholding tax for Portuguese source income paid to non-residents. And Form 2 RFI is how you request your tax residence certificate, the proof of where you're resident. Together, they let the treaty rate apply instead of the full domestic one. So relief works on two levels. At the source, treaty forms can lower or remove Portuguese withholding before income is paid. And at home, the foreign tax credit stops the same income being fully taxed twice, capped at the lower amount and capped again by the treaty. It's not tax-free and it's not double tax. It's coordinated tax, defined by law and by the convention. Quick recap: Portugal credits foreign tax up to the lower of the tax paid abroad or the matching slice of your income tax. A treaty can cap that credit and reassign who taxes what, income type by income type. And Forms 21 RFI and 2 RFI unlock treaty rates at the source. That's double taxation by the rules. Subscribe to Portugal Life Compass. Next, your first tax steps in Portugal, the NIF and the tax representative.